Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have on the line Bill Comfort. I consider Bill to be a mentor in the long term care insurance industry. He was my professor in the CLTC course, and therefore it's my pleasure to have him on the line today. Thanks so much, Bill, for joining us.
You're welcome, Mark. I'm glad to be here.
Okay, so I'd like to know, first of all, about your background. I know you've been in the industry for many years. How did it all begin?
Yeah, it started in the insurance industry in 1991, and like many people, did the basic boot camp training for a couple of years with a large national mutual insurance company, calling everybody I could find that I went to high school with that was still in town, and just all of the natural prospecting that you do. And after a couple of years of getting that general training under my belt, I joined my dad's insurance practice, which was primarily focused on employee benefits. And one of the things they said was, hey, if you're interested in specializing in something, why don't you look at disability insurance? We're good at group, but we're not good at adding to that. So that was something that suited me, that I enjoyed, and I picked up that expertise right away, even in my basic training, working with a lot of resident physicians that were my
Mhm.
peers at the time, 26 years ago, 27 years ago. Um, and there was a senior partner in the practice. I was in my early 30s. He was in his mid 60s. And he came to me one day with a stack of brochures and specimens and said, I've got a lot of clients asking me about this long term care insurance. He said, it's really disability insurance. You're the disability guy. Why don't you study this and tell us, what we ought to be selling? And he and I began to work jointly on that. And it really became an interest of mine. I discovered a few things along the way in the 90s. One, I didn't really like group benefits, particularly group health insurance.
Mhm.
But I also discovered I was wired better as a specialist than a generalist. So by the late 1990s, I was doing more and more long term care. I saw it as a great opportunity where very few people were specializing in it. And since 2000, that's really been my specialty, and my focus is on long term care planning and obviously long term care insurance.
Okay, so fast forward to today. What does your practice look like now?
So I wear a couple of hats today. Primarily, I sell, I advise, I engage with clients directly or in partnership with other agents, centers of influence, financial planners, and so on, in helping to plan for and effectively fund long-term care needs. It's interesting, I've added some disability insurance back in because advisors have asked me for it, because they can't find anybody that can really engage clients with the same way. And they're two sides of the same coin.
Mhm.
Disability during working years, long term care is a post retirement disability, if you think about it that
Mhm.
way. So they're very complementary. So that's one hat that I wear. The other is teaching. I've taught with and for the CLTC program for, gosh, probably 16, 17 years now, and I enjoy it. It ties into my past career as a broadcast journalist, and I enjoy giving back to and improving our profession.
It's awesome. And thank you for doing that. As a person who's been in your class, it was phenomenal. So I know you work with a lot of advisors and clients today. What would you say is their biggest objection or fear factor about putting a long-term care plan into place?
Yeah, naturally, the primary objection for everybody who has not lived it out in a deep personal way is thinking it'll never happen to them.
Hmm.
And there's a whole process to overcome and engage that. But really, I think once you get into this question of how do you fund, how do you design coverage, obviously affordability of premium is
Hmm.
critical. But along with that, I find a lot of clients and even their advisors, almost codependently sometimes,
Hmm.
getting trapped by looking at the highest potential cost of care, particularly at a nursing home, 10, 12, 13,000 or more a month, and feeling like they have to insure for that or most of that, where what's really important is the first claim,
Hmm.
the first things first, as I like to say, which is home care. It's where people want to get care. That's where spouses and families will try to take care of their loved ones, even to their own detriment, even to the caregiver's detriment. So home care comes first. And it's interesting, most people can't even afford on their own, without dramatic consequences, 3 or 4 thousand a month for part-time home care.
Right.
And that can lead to a very affordable, accessible long-term care insurance premium.
Yeah, I think it kind of gives you a feeling of hopelessness sometimes if you see those costs and you think about, okay, here's the worst case scenario. It reminds me, I was talking to an insurance executive in the 401k world, and how initially they were saying you need to save this much for retirement, millions of dollars to maintain your lifestyle. And they dramatically switched that to kind of a what's your number approach, a defined
Right.
contribution approach, and how effective that has been to getting people to save something. And I think it's the same thing. We're seeing that transition happening in long term care as well, which is, like you said, those first dollar benefits, that first care setting. It's really the most important thing for your family. It's going to buy you time. And then, of course, you can decide if you want to buy more of the catastrophic coverage, in addition to that.
Well, exactly. And I always want to put myself as the sales professional, but more importantly, for my clients, I want them to be in a position where they're choosing to buy up to fit what they perceive a need or risk to be, and to buy up into a budget that they choose to afford,
Hmm.
as opposed to selling this worst case scenario, high cost expense,
Hmm.
and then you kind of have to sell down. And they're
Hmm.
like, well, why would I buy only 4,000 a month when you convinced me it was going to cost 8 or 10 or 12?
Right,
And
exactly.
it becomes a very unproductive um,
Yeah.
kind of vicious cycle at that point.
Not to mention the trust that you want to build with the client when they're in control of the purse strings and they're asking to do more. I think that's much more of a partnership approach to it than the client fearing that you're just trying to sell them something because of commissions or something else.
And part of the education that goes along with this is not just the cost of care in different settings,
Hmm.
but part of the education is to remind people that if they have the financial means, which can include long term care insurance and should include long term care insurance for most people, if they have the financial means to get care at home as long as possible, effectively, and without wiping out a spouse and kids,
Hmm.
personally, financially, and to transition to assisted living and memory care, a meaningful, moderate benefit, 3, 4, 5,000 a month, along with co-insurance once you get to a facility, can help you do that. And
Right.
if you do that, you're probably not going to go to a nursing home, or if you do, not for very long.
Yeah. And I think what would illustrate this point best is, I know you were sharing with me a story. It was kind of an extreme example to the downside. Tell us a little bit about this client and what you did for them.
It's so interesting. It's a case, it's a claim case, a sale that I'm really in many ways most proud of because of feedback that I had from the family as well. It was a woman in her early 60s. She was recently widowed. She had a good government pension, survivor's pension, Social Security, um, some significant savings and earnings from that, and nice equity in her home. And she said, if I need care, I don't want to stay at home because I know that my kids would be on the hook. So what would it cost for assisted living or a nursing home? And we looked at her income as a single person. And at that time, I was recommending $120 a day as a cost of care and maybe a reasonable benefit.
Mhm.
And she ended up choosing to buy $50 a day, no inflation. And her
Mhm.
idea was 50 a day, 1,500 a month with my income should pay for care. And if I move to a facility, I'll sell my house and that extra assets and income, there's my inflation hedge.
Mhm.
So she went on claim about 4 years in. It was unusual. It was one of those dementia cases that nobody knew or saw coming. And about 4 years into the claim, I happened to talk to her son about how things were going. And he mentioned how much the family appreciated the $50 a day. And I started to apologize. I started to say, you know, I'm sorry I didn't press your mom to buy more, or at least add the inflation. And he cut me off. He said, Bill, don't you dare apologize to me. He said, let me tell you, he said, not only are we not spending 120 a day, we're spending 180 a day. This was at that time. He said, and mom could live another 8 years. He said, but every way I look at this, and I've run the numbers, we're spending all of our income, all of the earnings off of our investments, including the house that we've reinvested. He said, but every way I've looked at this, that $50 a day will keep us from ever touching the principal. He said, you saved the inheritance. Why would we be upset?
Right. And I know a lot of advisors are afraid of that scenario where they're co-insuring, but that's the key is this is paying for the first dollars of benefits, and they're going to be grateful that they've done something instead of not having a plan at all, which is oftentimes the alternative.
And it's what's the extra that's needed? That's one way to look at how much to fund for with insurance, or what is the amount that you can use that would take the pressure off significantly. Your portfolio, let alone the emotions of spouse and kids who worry about money, along with worrying about your safety.
Right. And when you told me this story, it reminded me of a viral newspaper article from a couple of years ago. It was the wife digs through dumpsters to pay for her husband's assisted living. And really, it was an inflammatory type of title, which is why it got spread around a lot. But the key is she had $4,000 of income for the family. His assisted living cost $4,000 a month. And so she was spending every last dollar because till death do us part, she wanted to take care of her husband, and she didn't leave anything left for herself. And what would $50 with no inflation do for her? $1,500 a month to cover her costs, because you're using that to pay the policy. It frees up the money to pay for your costs. Oftentimes it's that surviving spouse that's the beneficiary of that plan.
Exactly. And I think the story illustrates something else that we have to keep in mind. I hear from, agents or advisors, well, if I don't sell enough, or if I don't sell the right inflation benefit, or if I don't sell a long enough benefit period, the kids will sue me. The kids are going to hug you.
Right.
The kids are going to be thankful for whatever is there. But more importantly, if it's designed properly as part of a plan, which we talk about all the time, and respectful of, and in combination with other assets and income that the clients have, that's doing it the right way. I think about the flip side. What if you hang your hat on 8 or 10,000 a month of benefits for 6 years, if not longer, with this high inflation deal, and the clients go, I can't afford that, and they do nothing?
Right. That's
3 or 4,000 a month will save families' lives, and I mean literally health and life and lifestyle along the way. So that's this idea of right sizing, and we shouldn't be afraid to sell something that looks basic if it's really appropriate into their needs.
Awesome. Well, thanks for joining us on this episode. I'm sure we're going to have you on future episodes. We have so many stories to share. But thanks for your time.
You're welcome.